the big story yesterday was, of course, Jensen Huang, keynote, CES, and what he was going to talk about and how the market would react to it for a stock, frankly, that hasn't done all that much lately. If you back this out, you can get the picture. Last 3 months, for example, just take a look at what Nvidia has done. Yes, he talked about faster AI chips. Yes, he talked about robotics, which many obviously think of as the next big wave. And this Vera Rubin chip is now in full production, which people like Stacy Rasgon at Bernstein, top analyst, suggests, in his words, looks like a monster. The rest of the keynote was more incremental, but that seems to be the big takeaway from Mr. Rasgon, Dan Ives, et cetera. Let's talk to another big shareholder in Nvidia. It's Brad Gerstner. He is the Altimeter founder and CEO, and he joins us now, his first appearance of 26 with us, and it's great to see you. Thanks for coming on today.
Great to be here, guys. Happy New Year.
You as well. So what was your thought about the Jensen Huang keynote? Your big takeaway, is it a needle mover in any way?
Well, maybe just a comment first, Scott. I think that, you just ran around the horn on the desk, and I think everybody is spot on. This is going to be a stock picker's market. It's not 2023 or 2024, where we were early in this super cycle and we were recovering from the pullback in 2022. And remember, last year wasn't straight up and to the right either. The NASDAQ was down 20% on Liberation Day in April of last year and ended the year up 20%. And so I think there's a lot to be excited about as you look at this year. But as Venezuela reminded us over the weekend, as the SCOTUS decision on tariffs will probably remind us, there's certainly a lot of things we have to get through this year. But if we just look at the general operating framework, and then I'll get to Nvidia, lower taxes, we're in a rate cutting cycle, inflation under control, earnings growth is occurring. We've got this AI super cycle, this massive investment super cycle. We have this reindustrialization and bringing on re-onshoring our national supply chains. That's also a huge investment super cycle. So the backdrop looks good. And then we have these companies that are all getting more fit, right? They're leveraging AI. This is tough for the employment picture, but it really does lead to this golden age of margin expansion. And I think what you heard from Nvidia yesterday was a lot more of the same, right? The consensus estimate this year, I think, is that they're going to grow earnings about 65%, maybe 30% in 2027. You said it's an earnings-driven market, so they don't need to expand multiple. The multiple's 25 times earnings. It peaked in July of 24 at 41 times earnings. It troughed last April at 21 times earnings. Now we're at 25 or 26 times, so it's not a demanding multiple. And as a shareholder, Scott, I'm thrilled and happy just to sit here and let an incredible company generate earnings and let our returns come from earnings. We don't need our returns to come from multiple expansion in Nvidia.
You sound like somebody, if you paint the picture that you just did of the backdrop which you think exists, who's taken their exposure up, I would say. I don't know the answer to this, so I'm going to ask you straight up. That's what it sounds like, that you've increased your long exposure to this market. Is that fair?
That's fair. So let's just walk through, last year. We started last year medium large in terms of our exposure. By April, we were tiny in terms of our overall exposure to the market because of our fears about, I came on this program and talked about, the Navarro nuclear option around tariffs. We were back in the market extra large in May. We stayed there for most of the year. We pulled back in October because things started getting really frothy. But as the market came in, right, as Nvidia went from $210 a share back to $170 a share, we were buying that. And so we're back into a medium large position as we start the year. But as the desk said, this is a stock picker's market. So our biggest bet is in AI infrastructure, Nvidia, TSMC, Hynix, Samsung, Amazon, Microsoft, Coreweave, Google. We think that we're still very early in the super cycle. People, it's hard to believe, but we're underestimating, right? Think about the total CapEx here, Scott. In 2023, these companies spent $150 billion on CapEx building out data centers. This year, over $500 billion. That's not speculative. That is purchase orders. Those are buildings. That's power. That's stuff that we know is coming online, chips that we know are going to get deployed. And frankly, they would buy a lot more if they could, but we just don't have enough powered shell in order for them to deploy more than the 6 gigawatts in the case of Amazon that they're going to deploy this year. And so we think that will continue to play out. It's where the majority of our bet sits today. And we think, we don't rely on earnings multiple expansion in order to get paid this year. All of these stocks are trading in mid-20s in terms of their multiples. In the case of something like Coreweave, which has fallen out of favor, trading at 5 times EBITDA. So, we think there's an opportunity if they just deliver the numbers that we expect them to deliver this year.
You think that the Coreweave concerns are overdone? Is that what you're saying? Because the market obviously had punished this name with some of the other neoclouds, and there's questions about debt, and you had almost a same sentence conversation with there's the Oracle, which is under some heavy pressure, and you see the CDS blowing out, and then you've got the Coreweaves that are in that group too. Is that overdone?
Yeah, I mean, think about the way the market behaves, Scott. It was all in and then all out, right? The babies get thrown out with the bathwater. All neoclouds get treated the same. We were investors in Coreweave when it was a private company. We've been investors, as they entered the public market. And as it's pulled back here, we've added to our position. We're not adding to other neoclouds. We don't think other neoclouds are created equal. We think Coreweave stands alone in terms of its performance, the software that is built on top of the cloud, its execution capability, its strategic importance to Nvidia in terms of deploying Rubin, et cetera. And so we think it makes a really interesting opportunity. Now, let me be clear, that's further out on the risk spectrum, and the core of our bet this year is on things that we think are, less spicy than that, the Nvidias, the TSMCs, the Hynix of the world, where, they're absolutely critical to just making sure that the AI build-out continues.
The other name I want to talk to you about, because I find it conspicuously absent from your top holdings, which your team sent us, and Meta was not on the list, which jumped out immediately to me. And you just mentioned in your commentary about the whole AI trade and how you're viewing it as you have companies getting more fit. Those are the words you just used, which made me immediately think of Meta because of the now famous letter you wrote to them a few years ago now, arguing that they needed to get more fit, which they did, which caused a turnaround in the stock and rebuilt your trust, I think is fair to say, in that name. Because it's not on your list, do you no longer own Meta?
We don't own Meta today, but let me just share my thoughts. We invested in Meta in the fall of 22. I mean, we've been investors all the way back to 2012. We wrote that letter in the fall of 22. It became our largest position. The stock went from $90 a share to over $700 a share. And, as we looked at the transition they need to go through, I think Susan Lee has done an extraordinary job of managing the efficiency side of the business. But they're in a tough transition to take advantage of AI. We know they've, bought Scale AI. They brought in Alexander Wang. They've rebooted the AI lab over there. I think there's some real bright spots and some green shoots in terms of what they're building and how that's going. But the fact of the matter is they're not market leaders today in AI. They're huge beneficiaries from AI. We think the company's going to continue to do well. We're looking at it. It certainly would be a name that I would be happy to own. But in terms of the bets that we want to make this year, we think the companies that are trading at lower multiples where we have obvious catalysts in terms of their growth this year is where we want to have our dollars. I don't think this is a year where you just own everything. I think it's a stock picker's market. I agree with the desk that you have to be discerning. And so this is one that we're not in at the moment, but I would reserve judgment. I'm happy to get back in it. I think it's an incredible team. I think they're doing some good things, but they have some catch-up work to do in terms of AI, that's for sure.
All right, so you may still get the holiday card next year. I mean, even though you don't own the stock.